Saturday morning, 1968. Families lined up at the local bank, passbooks in hand, depositing $30 or $40 a week. Nobody called it discipline. It was just what you did. Interest paid 5%. The saving ratio sat at 11%. A home cost 4.5 times the average wage. Australians used to save more, not because they were more virtuous, but because the system rewarded it. That system is gone. The passbook sat in the kitchen drawer, thick with the weight of ink and habit. Each Saturday, it came out with the grocery list and the car keys. Families filed into the branch, the same faces in the same queue, children fidgeting while their parents thumbed the soft-edged pages. The teller would take the passbook, enter the deposit, $30, maybe $50, and stamp the new balance with a practiced hand. It was a small ritual, but it carried a kind of quiet pride. Elder A remembers the smell of the paper and the sound of coins sliding across the counter. You didn't have to think about it much. You just did it. It was part of looking after your family. Back then, a modest deposit each week, $30 or $40, sometimes a little more, was enough to see the numbers grow. The bank paid interest at 4%, sometimes 5%. That return was steady, not a windfall, but it meant your savings worked for you, not against you. The numbers added up. An average household saved around 11% of what came in, without spreadsheets or sacrifice. The passbook made it visible. You could see the balance inch upward, line by line, and know you were getting somewhere. There was no mystery, no shame, no sense that saving was an act of heroism. It was just what people did together in a system that made it feel normal. The discipline was real, but it was rewarded. That's what made the habit stick. In 1970, the math of saving for a home was simple enough that nobody needed a calculator. The average Sydney house cost about 4.5 times the average household's annual income. That meant a family earning around $4,100 a year could look at an $18,700 house and know the goal was within reach. Weekly deposits of $30 or $40, what most families managed to tuck away, didn't just feel good, they actually made a difference. With banks paying 4 or 5% interest on savings, even modest deposits grew steadily, and the numbers on the passbook told a reassuring story. A typical family saving around 11% of their income could put aside more than $400 a year. In just 2 or 3 years, that added up to a deposit big enough for a mortgage. The rest of the purchase was covered by a loan, usually at a fixed rate with strict lending rules that kept repayments predictable. Wages were rising faster than prices, so each year the goal got a little closer, not further away. The system didn't ask for heroics or luck. It rewarded steady, ordinary effort with real, visible progress. That's the part that is so hard to explain to younger Australians today. Back then, the gap between what you earned and what a house cost was narrow enough for discipline to matter. Saving wasn't a test of character. It was a path that worked year after year for anyone who stuck with it. The numbers weren't just friendlier, they were fair. In December 1983, the Australian dollar was set free. Paul Keating, then Treasurer, announced the float in a press conference that is now etched into economic history. Until that moment, the Reserve Bank and the Treasury had kept the currency on a tight leash, managing its value and the flow of money in and out of the country. Floating the dollar was sold as a step into modernity, but it also opened the door to a world where global capital could move in and out at will, and where interest rates would be set by markets, not by government decree. The float was just one part of a broader push. Over the next few years, the government removed caps on what banks could pay for deposits or charge on loans. Foreign banks were welcomed in, bringing new products and a hunger for market share. The old model, where banks earned a steady margin by rewarding savers and lending cautiously, was flipped. Now, profit came from chasing higher loan volumes, not from building up domestic savings. The Financial System Inquiry, launched in 1981 and reporting through to 1984, laid out the blueprint: more competition, more choice, and less regulation. For ordinary Australians, the change was quiet but profound. The interest paid on a savings account was no longer guaranteed to keep pace with inflation. Banks started to focus on mortgages and credit cards, not on passbooks and term deposits. The incentives, once tilted in favour of careful saving, now lean toward borrowing and spending. Economist Dr. Alison McCallum puts it plainly. Deregulation did not just open the doors to foreign capital, it closed the chapter on the old saver's contract. The rules had changed, and so had the game. What had once been a system that rewarded discipline and patience became one that asked households to bear more risk, and to do it alone. Interest rates once made saving feel like a slow but steady climb. In 1990, the Reserve Bank's cash rate hit 17.5%. For a family with a mortgage, repayments doubled almost overnight. But the real squeeze did not end with that spike. It settled in quietly as three forces began to grind away at the old logic of saving. First, the cost of a home. In the 1970s, the average Sydney house cost 4 or 5 times the average household income. Today, it's nearly 13 times. That means even if a young couple manages to save at the same rate their parents did, the finish line keeps moving further away. The deposit that once took a few years now takes a decade or more, and that's if nothing goes wrong along the way. Second, work itself has changed. Nearly 27% of employed Australians now hold casual or non-permanent jobs. That's more than double the rate in the 1970s. Wages arrive irregularly, hours shift week to week, and it's almost impossible to set aside a fixed amount each payday. Not a personal failure, a mathematical reality. The old habit of putting something away every Saturday simply doesn't fit a world where pay cycles are unpredictable, and the next shift is not guaranteed. Finally, essentials eat up more of every pay packet. 40 years ago, about 20% of household income went to basics like rent, power, insurance, and groceries. Now it's closer to 38%. That leaves less room for saving, even before thinking about school fees or medical bills. The numbers aren't just tight, they're suffocating. For a young household today, the discipline of saving has to fight uphill against all three of these forces at once. The system that once made saving feel normal now makes it feel almost impossible. And it's not about willpower, it's about the maths. In October 1974, Bankcard arrived, the first homegrown credit card promising Australians the freedom to buy now and settle up later. The ads were everywhere, a flash of plastic, a smiling couple, slogans about power and possibility. At first, only a handful of households had one, less than 5%. But the idea caught on. By 1990, 7 in 10 adults held a credit card, and the ritual of waiting, saving, and planning was quietly replaced by the swipe. Banks, once built on rewarding savers, found bigger profits in lending. Instead of earning interest for leaving money untouched, customers were nudged to spend, with banks collecting fees and charges on every transaction. The old discipline, waiting for the balance to grow, feeling the weight of each deposit, gave way to something faster, more private, and less forgiving. The system no longer paid you to be patient, it paid you to reach for the card. At its peak in the mid-1970s, the average Australian household saved 18.5% of what they earned. Today, that figure hovers around 6%. The difference is not just a number on a chart, it is a shift in what it feels like to be secure. Nearly half of Australians now say they could not cover an unexpected $1,000 expense without borrowing. Elder B puts it simply, we never felt rich, but we did not worry about the basics. You knew your savings would get you through a rough patch. That confidence has faded. What is left is a sense of fragility, Not from a lack of effort, but because the ground has shifted under everyone's feet. They were not thriftier, smarter, or more disciplined. They lived in a system that made saving possible, and that system is gone. Today, saving isn't just harder, it's structurally different. This is not a personal failure, it is a mathematical reality. The Australians who saved in 1968 were not more disciplined. They lived in a system that rewarded effort. That system is gone, and every struggle to save now tells us exactly how much has changed.